Most traders believe they're losing because they don't know enough. They think the problem is the chart, the strategy, the indicator. But here's the uncomfortable truth most traders never want to hear. Trading success or failure is rarely decided by what happens on the chart. It's decided by the math and the risk behind the scenes. And if the math is wrong, nothing else matters. You can be the best technical analyst in the world. You can understand macro better than most professionals. You can call market direction correctly more often than not. And you can still lose money consistently if the math is broken. In this lesson, we're going to strip trading down to its foundation. Not indicators, not patterns, not opinions. Math, risk, probability, survival. Because once you understand these elements, trading stops feeling random and starts behaving like a system that works over time. Why most traders are losing and don't realize why. Let's start with a simple question. When you sit down to trade, what is your real goal? Most traders would answer, to make money today, and that sounds logical. Make money today, repeat that every day, live profitably. But that goal, make money today, is one of the most dangerous goals you can have in trading, because the moment today's profit becomes the objective, decision-making collapses. You start taking trades that aren't part of your plan, taking too many trades, forcing setups, increasing risk, holding losers, cutting winners early, not because you're reckless, but because you're emotionally attached to a short-term outcome. And that's how traders unknowingly lock themselves into negative expectancy. Pillar 1. Positive expectancy. The only thing that matters long-term. Everything in trading begins and ends with expectancy. Expected value, EV, is the mathematical result of your actions repeated over time. A negative EV approach means if you repeat your behavior long enough, you are guaranteed to lose. A positive EV approach means if you repeat your behavior long enough, you are statistically guaranteed to win. This is where most traders get it completely backward. They judge success by today's profit or loss. Win today? Good trader. Lose today? Bad trader. But that logic has nothing to do with long-term profitability. Markets are unpredictable. Outcomes are random in the short term. Judging yourself based on daily results is like judging your fitness based on one workout. It makes no sense. Trading without expectancy is no different than spinning a roulette wheel. You might win today, you might win tomorrow, you might even win several days in a row. But eventually, probability catches up. And when it does, it wipes out everything you built. The critical shift. From outcome-based to process-based thinking. Most traders wake up, take trades, and then emotionally weigh their day based on P&L. That creates a destructive loop. Loss equals failure. Win equals success. Emotions override logic. Discipline disappears. A positive expectancy trader does something completely different. They judge success by execution, not outcome. Did I follow my rules? Did I size correctly? Did I take only valid setups? If the answer is yes, it was a good day, regardless of profit or loss. Why? Because a proven system produces results over a large sample size, not over a single day. Profit is not the goal. Profit is the byproduct. Why win rate is largely irrelevant. One of the biggest distractions in trading is win rate. Traders obsess over being right. But the market does not reward being right. It rewards risk asymmetry. You can win 70% of your trades and still lose money. You can lose 70% of your trades and still make money. What matters is average win size, average loss size. If your losses are small and your wins are large, the math works, even if you lose more often than you win. This is where consistency is born. Risking 1% to make 3% creates positive asymmetry. One win pays for 3 losses. A system like this can be profitable even with a low win rate. That's not theory. That's math. Stop trying to win more. Start trying to lose better. The first action step. Stop chasing daily profit. Stop trying to be right. Start building a system where losses are controlled, wins are larger than losses, execution is repeatable. Turn trading into probabilities, not predictions. Pillar 2. Variance. Why good traders still lose temporarily. Here's where many traders break. Even with a positive expectancy system, losing streaks are unavoidable. You can do everything right and still lose. You can do everything wrong and still win. That's variance. Variance does not mean your system is broken. It means probability is distributing outcomes unevenly in the short term. And this is where most traders sabotage themselves. The two types of dangerous variance. Weak system variance is when a bad strategy works temporarily. It creates false confidence. Traders mistake luck for skill. Eventually, the system collapses. Strong system variance is far more dangerous. This happens when a good system starts with losses. The trader loses confidence. They abandon the system. They jump to something new. They repeat the cycle. Many traders have unknowingly quit highly profitable systems right before they would have worked. Why short-term performance is a trap. Most traders give up after 10 trades. That's nowhere near enough data. A profitable system can look terrible early on. A losing system can look amazing early on. Only large sample sizes reveal the truth. You cannot eliminate variance. You can only outlast it. The traders who survive are not the ones who avoid drawdowns. They're the ones who can safely execute through them. The second action step. Anchor yourself to process, not outcomes. Track. Rule adherence, position sizing, setup quality, execution consistency. Your job is not to win today. Your job is to execute correctly across a large sample size. The math will take care of the rest. Pillar 3. Risk exposure, the silent account killer. You can have a great strategy, positive expectancy, emotional control, and still blow up if risk exposure is wrong. There are 3 critical types of exposure every trader must control. Individual trade risk. Risking 1% per trade protects you from destruction. 4 losses in a row at 1% equals a 4% drawdown. That's manageable. Recoverable. Psychologically stable. Increase risk, and damage accelerates. Losses compound. Recovery becomes exponentially harder. Deep drawdowns don't just hurt your account, they destroy decision-making. And poor decisions, not losses, are what end accounts. Multiple trades can secretly be the same bet. Different instruments, same underlying exposure. When correlation works against you, losses stack instantly, risk compounds silently, and traders don't realize what happened until it's too late. Limit exposure. Understand correlations. Never stack risk unknowingly. Time-based exposure. Even with perfect risk per trade, too many trades in a short window can destroy capital. Overtrading creates cascading losses, fatigue, emotional errors, revenge behavior. 1 to 2 quality trades per day is enough. Capital preserved is infinitely better than capital lost. The third action step. Risk no more than 1% per trade. Avoid correlated exposure. Limit daily trades. Protect capital above all else. Survival comes before growth. Always. Why this matters more than anything else. This lesson wasn't about setups. It wasn't about indicators. It wasn't about predictions. It was about how traders survive long enough to win. Positive expectancy gives you the edge. Variance explains the pain. Risk exposure determines whether you live to see the payoff. There is one final piece left. The bridge between knowing and doing. Between information and execution. Between theory and results. That's where most traders truly fail. And that's what we'll cover next. Because ideas don't make money. Execution does. And when you learn how to execute correctly, consistently, and unemotionally, trading finally starts working the way it always should have.